What's up everybody? Nate here. So the stock market has gone crazy since the start of 2022. In fact, we've seen the Dow, S&P 500, and NASDAQ all fall off of their record highs that they set back in 2021. This big pullback so far has been fueled by three things. First off, inflation hit a new 40-year high of around 7.5% in January 2022. Next, the Federal Reserve has promised to get even more aggressive on inflation, with some saying a 100 basis point hike is coming in 2022. And of course, we have the Russia-Ukraine situation, which is only getting worse every single day, with the United States and President Joe Biden now saying that an invasion by Russia is imminent and could happen as early as this week. None of this has been good news for the stock market, and unfortunately, things are about to get a whole lot worse. By mid-February 2022, the Federal Reserve had an emergency meeting about its interest rate hikes and economic stimulus. And its new update, coupled with the Ukraine, Russia, and inflation situation, may end up leading the stock market into its next crash. Which is exactly why we've started to see investors pull their money out at a record pace, and pretty much every single stock start to tank. But what's coming next isn't just bad for the stock market, it's bad for our entire world economy in general. And unfortunately, there's not really much we can do to stop it. So today I want to talk all about what is going on in the stock market right now, why are stocks sinking again, will they continue to do so, and everything you need to know about the Russia-Ukraine situation and the brand new Federal Reserve meeting update. But before we get into all of that, do me a quick favor and hit, smash, or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk all about what is tanking the stock market right now. The first thing we need to talk about is inflation. Inflation for January 2022 came in at a 40-year high of around 7.5%. That worries investors for a lot of different reasons because of the effects that inflation has on businesses. When we have inflation in our economy, that means the price of just about everything is gonna go way up. Now that's gonna hurt regular everyday Americans because now they're going to have less money to buy all of the same things. And it would be different for the New York Stock Exchange if inflation was just going up for one particular month, but it's actually been going up for the past 20 months. That's almost 2 years of consistent inflation that's been going up at record rates. So for one, that hurts consumers because now they can't buy all of the same things they could before because they just don't have as much money. Next up, it hurts businesses because businesses have a lot less money to go around. Their profits are directly affected by how much people are buying. People start buying a lot less because of inflation. Companies and businesses are forced to cut back. They have to find new ways to cut costs. Normally that would mean cutting their production or laying off or firing people, but that's really difficult in this economy because we also have massive supply chain issues. When the pandemic first started in March of 2020, businesses were shut down for a very long time. They got super behind on their production. And because they got super far behind, they weren't able to keep up with the demand that people had for all of their products. And one of the main reasons why demand was so high is because the United States government supplied just about everyone with thousands of additional dollars in economic stimulus. So we kind of had spending go through the roof in 2020 and in 2021, which threw off our entire supply chains. But not only that, because of the pandemic, a lot of businesses continued to shut down every so often throughout the last 2 years, which means they're just naturally supplying less things. But that's not all. By the middle part and end of 2021, we had millions of Americans voluntarily quitting their jobs. So far, this has been dubbed the Great Resignation, and it's led to a huge labor shortage in our economy. That means businesses aren't able to produce more products in order to meet demand because the workforce is so limited right now. They can't find enough people to fill positions to actually make more products. We are running out of just about everything, which is fueling inflation even more. Now, the stock market doesn't like it when inflation gets this high because it's bad for just about everyone. People aren't able to buy all the same things they could before because they don't have enough money. So businesses have to keep raising wages and salaries throughout their companies for their employees to continue to go out and buy all of the same things. The Problem is, in 2021 and now 2022, wages and salaries have not kept up with the inflation rate in the United States. Since inflation in January 2022 was around 7.5%, in order to keep up with inflation, wages would have had to increase by that level. But so far, they haven't gone up even close to meet inflation. In 2021, wages actually did go up by around 4.4%, but that wasn't enough. Inflation was 7%. So even though employers were actually giving their employees more money, the employees weren't actually making any more. Everything costs significantly more than it did last year. So even though you got a raise, you're still losing here. Not only that, it means that everything in our economy is inflated. Earnings reports from companies that trade on the New York Stock Exchange are also inflated. Assets like stocks, bonds, and cryptocurrencies are also inflated in value right now because everything is costing more naturally. That means if inflation at one point does go down, all of these assets and earnings reports are probably going to decrease too. So investors right now don't know if they're buying at the top or the peak of the stock market or if they're buying at the bottom. And that's led to some massive volatility because investors are basically just guessing on what's going to happen next with inflation. What will help them, though, to understand what's going to happen next is the Federal Reserve. Which brings us to number 2. The Federal Reserve had an emergency meeting today about its monetary policy on interest rates and its quantitative easing program on Wall Street. Now, the reason it's an emergency is because they weren't scheduled to have a full meeting until next March. That's when they were officially going to decide all of their monetary policies regarding interest rates and their economic stimulus. However, they were forced to because inflation is so high right now, and it's a response to the newest CPI report that showed inflation's gone up by 7.5%. It's the Federal Reserve's job to monitor inflation in the United States and try to keep it at a healthy level. For the Federal Reserve, that means an inflation rate of around 1 to 3%. They base that off of a healthy economy. So if your economy is healthy and it needs to grow, then you need more money, which means more money printing from the Federal Reserve. You don't want to do way too much money printing though, because that could lead to a lot of other economic problems. Like we saw in 2020 and in 2021, there was just so much money in the economy that people were going out and buying way too much stuff. Now, if this happens over time, it's not really that big of a deal. Like I said, what inflation basically means is that the price of everything is going up. So if inflation is at 7% right now, that means anything that costs $1 today is going to cost $1.07 a year from now. It's not really a big deal because typically wages will continue to go up. It's usually not 7%, it's usually only at around 2%. That's enough for businesses to be able to afford if the Federal Reserve has to pump even more money into our economy. And they do this every single year. But in this meeting, the Federal Reserve discussed how it was going to address inflation in the United States. And one way it's going to do that is raise interest rates. The stock market has been kind of on the fence about how much the Federal Reserve is going to raise its interest rates in 2022. However, the general consensus from investors on Wall Street was that the Federal Reserve was going to raise its benchmark interest rates by around 25 basis points 3 to 4 times this year. However, the St. Louis Federal Reserve President James Bullard now believes that the Federal Reserve is going to raise its benchmark interest rates by 100 basis points multiple times in 2022. That would be the most aggressive the Federal Reserve has ever gotten on inflation. Now, from the Federal Reserve's perspective, raising interest rates basically takes all of the demand out of your economy because now it's a lot harder for people to go out and get a loan and spend money in general. If people aren't spending as much money, then inflation is going to start going down because that signals to businesses that they don't need to produce as much and prices will eventually level out because your supply and demand will hopefully reach an equilibrium. They did kind of the reverse thing in 2020 because back then they wanted to incentivize people to go out and spend money. So they dropped their benchmark interest rates down nearly to 0%. But then people had so much access to money that they went out and spent like crazy. We saw the housing market explode in 2020 and in 2021 because now it was super easy for a lot of people to go out and get a mortgage loan or a car loan. Car prices also have exploded over the last year with new car prices going up by around 12% and used car prices going up by nearly 40%. But now in 2022, the Federal Reserve is basically taking all of that money away because they're going to start raising their benchmark interest rates, so that way it's a lot harder for people to spend money. Now, people are still going to spend money in our economy. It's not going to be that everybody can't get a loan, but people who are able to get a loan are going to be the ones that can afford these crazy prices right now. And that's the big worry in the stock market right now, is that when the Federal Reserve raises its benchmark interest rates, banks and other companies are going to start getting hurt because now people aren't spending money. In this meeting, the Federal Reserve talked about front-loading its interest rate hikes so that way the economy can start to recover right now, and then lowering those hikes as the economy progresses. So basically it would work like this. The Federal Reserve raises its benchmark interest rates by 100 basis points right now, and then next quarter they start to lower that by 75, 50, or even 25 depending on how the economy reacts. Because our economy is way over accelerated right now, people are spending way too much money and there just isn't enough supply of things, that would help immediately lower demand in our economy, and then the Federal Reserve can adjust it if people aren't spending enough or if they're still spending way too much. With that being said, the stock market now believes that each hike from the Federal Reserve is going to come at 50 basis points, which is 25 higher than they previously expected. Again, what this means for the stock market is less spending overall. It means your economy is going to start shrinking because it's way over accelerated right now. People are spending way too much money and they have way too much access to money, and every single market, from prices to assets, is overinflated. And the Federal Reserve can lower that by raising its interest rates and pulling a lot of the money that it's been pumping into the New York Stock Exchange. And that's the second thing that the Federal Reserve is going to do. By March of this year, it's going to pull and end its quantitative easing program. So since about March or April of 2020, it's been buying hundreds of billions of dollars in assets on Wall Street. These were mortgage-backed securities, corporate bonds, and treasury notes. All of this was supposed to lift up our markets out of one of the fastest crashes we have ever seen. And for the most part, it did, albeit completely artificially. The Federal Reserve was basically pouring so much money into the markets that markets kind of got pretty risky. They were throwing money at pretty much whatever they wanted to because they were betting with Uncle Sam's money and not their own. But now all of that is pretty much going away, so a lot of your risky assets or unproven assets like your brand new tech startups and IPOs are going to go away. It's not the environment to start an IPO or launch as a public company on the New York Stock Exchange because investors have to put their money into proven assets. It's harder to trade on margin because interest rates are going up and they don't have a lot of that free money that the Federal Reserve was pouring into the markets anymore. So markets now have to trade with only their money. And when it's their money on the line, well, they're going to be super careful about what they're investing in. And finally, we have to talk about the Ukraine-Russia situation. Because even though at the surface it might not look like it directly links to the stock market, what happens there will have a massive impact over the future of the stock market. Basically, at the end of 2021, Ukraine was slated to become a new NATO nation. However, Russia really didn't like that because of how close Ukraine is to its country, and it didn't want a NATO ally so close to it. So since then, they have been sending thousands of troops to the Russia-Ukraine border. And while Russia hasn't directly said that they're going to invade Ukraine and take it over, the implication is that's what's going to happen very soon. Now, recently, President Joe Biden had a phone call with Russian President Vladimir Putin to try to talk him out of invading Ukraine and in turn, removing all of his troops from the border. However, it did not go well because immediately after that meeting, the United States is now saying that Russia could invade Ukraine any day now. And on that news, the stock market tanked as well. Now, there is a lot going on here. This is a massive geopolitical issue and is highly complex, but the first thing we need to talk about is the price of oil. Oil futures in Texas are up right now. They're projecting that a barrel of oil could cost around $94 very soon. However, if Russia actually does invade the Ukraine, one barrel of oil could cost around $100. And because the United States and the rest of the world is so dependent on oil, that can mean the prices for suppliers and then producers ultimately gets trickled down to the consumer, which means gas prices in the US and energy prices are going to go way up. All that does is add to inflation even more, because now Americans have to pay more for something that they need almost every day, which means they're spending less money on products and services from businesses. But not only that, there's a lot of economic economic resources around Ukraine and Russia that the United States needs for businesses. And if there was an invasion and any kind of economic resources needed to be reallocated to Ukraine, well, then that's less money for the Federal Reserve and the United States government to provide to its own country. I mean, I guess the United States Federal Reserve could just print a lot more money to pay off all of its debts and bills, but all that would do is contribute to inflation even more. Not only that, but there is a big potential that China might end up backing Russia in its invasion of Ukraine. The United States relies on China for a ton of economic resources. And if the United States was to enter into some kind of conflict with Russia who is backed by China, well, then China may end up imposing a ton of sanctions on the United States, which would drastically affect our economy. Now it's going to be harder for the US to get a lot of its materials or products that it uses every single day. And if it has to get those and pay even more for those, well, now businesses are going to be taking a massive hit from all of these sanctions. So not only are businesses having to pay people a lot more because wages need to increase because of inflation, well, now they're having to pay more because of extra taxes and sanctions from Russia and China. Meaning just about every single major business and corporation is going to fall in 2022, and they're gonna fall hard. Which is why the stock market has started to sink, because now investors by the thousands are taking their money out of the New York Stock Exchange. They're cashing out because they believe that this is going to be the highest that we're going to see the market in a long time. So they're getting out of there, and they're either investing in other things like commodities, or they're just taking their cash and holding it. And that's the thing. The United States Federal Reserve can't really do much about inflation if it's being caused outside of their jurisdiction. If the inflation is happening because of the Ukraine-Russia conflict, well, there's not really much they can do. Raising interest rates in the United States isn't going to fix a potential war overseas. And ultimately, if markets and US citizens are struggling because of inflation, well, the Federal Reserve is going to have to support the country. That's what it did back in 2020, and it will most likely do the exact same thing. It's going to print its way out of this problem. And that might help the economy in the short term. Like back in 2020, we ended up having one of the shortest recessions in American history because of all of the money printing. However, in the long term, that's hurting us bad. And chances are the Federal Reserve will need to do that again if things continue to escalate overseas. And ultimately, this is bad for the entire economy and our world economy, because inflation hurts the poor and middle class the most. That's because for the majority of Americans, their wages and salaries are not going up nearly enough for them to be able to buy all of the things that they need. They're now having to pick and choose, so spending goes way down in the United States. Not only that, but businesses can't keep up forever, and if their costs end up outpacing their profits, well, they're gonna go out of business, which means fewer jobs and more unemployed Americans. But the majority of Americans also don't have any assets that can outpace inflation like investments. And ultimately, you can go back and forth on whose fault that really is. Is it the average American's fault for not having any investments or savings, not protecting themselves in case of an economic disaster? But the bottom line here is that the majority of Americans just don't. They don't make enough money, and they don't have any investments in order to protect themselves. Which means this inflation problem is only going to get bigger. And it may end up killing our economy again. But now I want to hear from you on this issue. What do you think is the biggest threat to the stock market right now? And do you think the stock market is going to continue to fall or eventually rise in 2022? As always, whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. I hope you liked this video. If you want to stay up to date with all of the top business and financial news every single day, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner over here. And if video's more your thing, I'm putting out videos every single day on this channel, so if you want to stay up to date with everything happening in the business and financial world, I've got another upload for you right here, so be sure to click that before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.